put the spotlight on INOX Group, because this time around a steady set is what the company and what the group rather has reported, be it with respect to the green business, the wind, as well as Gujarat Fluoro. And to talk more on this today, we are being joined by the management of INOX Group. And with this, let me welcome Mr. Devesh Jain, who is the ED of INOX Group, joining us on the show. Hi, Mr. Jain. Very good morning, and thank you so much for your time. Firstly, it's been, let's start with your INOX Green business. What we see is that it's been the best ever quarterly performance by you. The profit has seen a surge of 363%. Help us understand what were the growth drivers for this particular stellar set, and what's the outlook going ahead?
Hi, good morning, Snehi. Good to be back on ET now. First and foremost, it was a record-breaking quarter, both for INOX Wind as well as INOX Green, where we've recorded our strongest ever Q2 performance. Having said that, in terms of INOX Green, I think obviously the numbers in terms of income, we almost doubled 101% to 130 crores. And our portfolio has grown from about 5 gigawatts now to about 12.5 gigawatts. So I think that is the most important reason why you're seeing a lot of this growth. And mind you, all of that is not reflected in our numbers yet. We'd made certain strategic investments via which we have access and control about 6.5 gigawatts of O&M assets out there. So overall, INOX Green is now a 12.5 gigawatt portfolio. Just to give you the broad metrics, typically a megawatt does about 10 lakhs of top line, and we operate at about 50% margins. So effectively, you can just do the arithmetic where this company is headed in the coming financial year, which is when we expect the entire 12.5 gigawatts plus to fully reflect in the P&L and on the balance sheet. Having said that, I think a couple of other things which we think are going to be fairly value accretive for INOX Green as we move forward are the facts that the group IPP, INOX Clean, as well as our solar manufacturing arm, INOX Solar, together with INOX Wind, should comfortably add 5 gigawatts per annum to INOX Green's already large portfolio. So we are very well on track to become India's largest renewable O&M services company over the next 1, 2, 3, 4 quarters. Second, I think we also have the demerger and automatic listing of our EPC arm called INOX Renewable Solutions, which is expected to happen over the next few months, which would be value accretive for both INOX Wind and INOX Green. So I think all in all, I think INOX Green is on a very, very strong footing for very strong and large profitability as we move forward.
And Mr. Jain, since you spoke about the demerger, if you can take us through the timeline, when are you expecting the approval from NCLT and the entire demerger process to be completed?
Look, so we already have the shareholder and creditor approvals. Should not be too long from here, but obviously, given we can't control, NCLT can't commit. Having said that, what I understand from our bankers, it should be a matter of a few months. Hopefully, within this financial year, we should see INOX Renewable Solutions being demerged and listed on the stock exchanges.
All right, but Mr. Jain, now let's shift focus and talk more about your INOX Green business. What we understand that you have acquired 6.5 gigawatt of O&M assets this particular quarter. How much of this 12.5 gigawatt portfolio consists of the third-party assets versus INOX Wind's owned commission capacity? And what is the expected run rate revenue margin contribution from these newly acquired assets?
Look, so overall, as I mentioned, out of the 12.5 gigawatts which we control currently, INOX Wind's turbines would be close to 3.5 to 4 3.5 gigawatts broadly to 4 gigawatts. The remaining 8.5, 9 gigawatts are all third-party assets, which we've taken control of, which we've, through strategic investments, control, operate, own. Overall, I won't spread and break up the margin contribution into INOX and non-INOX and solar and wind. Overall, I would say the blended top line for this entire 12.5 gigawatts would be roughly 10 lakhs per megawatt. And we would be operating on a blended basis at about 45 to 50% EBITDA margins.
So that's as far as margins are concerned. But Mr. Jain, you also reported strong cash profit in the quarter gone by. How do you aim to utilize that? Is it for your expansion plans or is it to reduce your debt profile?
Look, I mean, at the console INOX Wind level, we're a net cash group. And even at INOX Green, we're net cash. So, frankly speaking, I don't think there is any debt profile which we need to take care of or which we need to cover. In fact, our balance sheet numbers have been taken out in this quarter, and we're overall about 230 odd crores of cash, besides strategic investments of over 500 crores. So, I think a very, very strong and robust uh, balance sheet, both at the console wind level as well as on a standalone INOX Green level. So, frankly speaking, I don't think there's any debt to be taken care of. Number one. Number two, I think we're looking at multiple inorganic opportunities currently at INOX Green. So, as we move forward, yes, INOX Green, the board and the management should put in place a dividend policy, given it's a very, very strong annuity business. But currently, I think we're focused on very, very high growth. So, the next couple of months, we should be moving to a different regime. But currently, I think we're focusing on capturing all the opportunities which we possibly can in the market.
All right, but what about the working capital then? That remains to be a key focus for Inox Wind specifically, with the high H2 execution push. What steps are being taken to meet the target 120 days of net working capital cycle?
Look, I think it's well on track. I mean, we have a good mix now of turnkey orders, equipment supply orders. I think that's important. Naturally, Q2 is a quarter which is affected by monsoon, yet you've seen a record execution and manufacturing at Inox Wind. So I think we're extremely bullish and very strongly positioned for further execution and manufacturing. In fact, our newly commissioned plants in Gujarat, Kalyangar for nacelles, which has gone on stream over the quarter gone by and is continuously ramping up, puts us in a very strong position to enhance manufacturing. And I think uh, between, as I mentioned, equipment supply, turnkey, increased manufacturing, I think we're strongly positioned to achieve our working capital targets as we move forward. Give or take 30 days, a quarter here or there. I think we are extremely comfortable. I mean, we have a net cash balance sheet, as I mentioned, a very, very diversified and multiple customers to whom we are supplying and executing. I think I don't see that as a cause of worry, honestly speaking.
Okay, so the outlook continues to remain very positive with net cash position and as far as the demerger is concerned. Mr. Jain, thank you so much for taking your time out and joining us here on ET Now and helping us understand what the outlook is going forward. On that
Thank
note,
you
we
so
need
much.
to slip into a very short break, but many more managements will join us on the other side. Don't go anywhere.